Hi, good afternoon, everybody. How are you all? I'm sure all of us are doing very well. Markets are still close to all-time highs, right? And that's very important for our sentiment as such, right? So I should tell you that. So in the past 8 weeks, actually, I've had the opportunity to travel across India. In fact, I've traveled in 8 states from north to south. I was in Kashmir, I was in UP and Bihar, I was in MP and Chhattisgarh, Maharashtra, Goa, and now in Kerala, right? And the common feedback I have heard whenever I've asked this question, I've met a lot of our distribution partners across India. I've met with investors. I've interacted with a lot of other people, other businesses, and sentiment is still positive across the country. So that is the first takeaway I want you to leave with, that across the country, amongst investors, amongst businesses, amongst distribution partners, the sentiment is still quite positive, right? But at the same time, there are a couple of questions that have come up everywhere, right? Now with market close to all-time highs, the first common question I have faced is, okay, what should we expect from here, right? Can markets continue to go up from here, or should we expect a correction or a consolidation? And the second question is, are there still any pockets of opportunity left to invest, right? So I'd like to summarize this as, should we be cautiously optimistic or should we be optimistically skeptic, right? So before I tell you my view, I just want to have a show of hands, like, how many of you are cautiously optimistic? What it means is that you're optimistic for the medium to long term, let's say 3 to 5 years, but you are cautious right now considering where the markets are. How many of you are cautiously optimistic? Okay. And how many of you are optimistically skeptic? Means you're optimistic for the medium to long term, but you're skeptical about the current market rally. You think, there'll be a correction coming up. Okay. So what we'll do is spend the next 20-25 minutes discussing this question. I'll try and keep it a little bit interactive. So I'm going to ask you some questions, and if you want to ask questions, of course you can do that, right? Now, before I go ahead, I just want to share a personal story with you that a month back I had gone on a trek in Kashmir. I went with a group of 9 people to Varwan Valley Glacier, which is at a height of about 14,500 feet, right? And if anybody of you has gone on a trek to these heights, you would know that, it's physically very challenging. Oxygen levels are low, right? So at a height of 15,000 feet, oxygen levels are about just 60% of that at sea level. And for example, Mount Everest, which is at 30,000 feet, oxygen is only 33% of that at sea level, right? So even our mind doesn't work properly. Decision making also becomes difficult, right? And number of times during the trek, I felt that maybe I couldn't do it, right? This was a 7-day trek covering 85 kilometers. And a couple of times I felt maybe I wouldn't be able to finish the trek. I should stop or go back. But fortunately, I had the determination, so I managed to finish the trek, right? There was an important learning for me that personally there are a few things needed if we want to complete this kind of a trek. So before I tell you the answer, I'm going to ask you, if let's say you or me or anybody else wants to do such treks, go to new heights, 15,000 feet, 20,000 feet, 25,000 feet, 30,000 feet, what do you think is needed from us? What are those 2 or 3 personal characteristics that we need to go to new heights? Physical fitness, very good, yes. Physical fitness, stamina, very important. Confidence, right? So that's, I would call it like, mental strength, right? And the third, determination, yes. So that comes in mental strength. And the third, like I mentioned to you, it's oxygen, right? So these are exactly what you mentioned. Physical fitness is very important to complete the trek. Mental strength is very important. Number of times we will feel we can't do it. We should stop, go back. Determination is important. And third, oxygen is very important to survive and take the correct decisions, right? And when I came back, when I thought about it, I realized that this is the same for markets also, right? So if you think about it, markets are at all-time highs, right? And when we try to answer the question, can they go up from here or will they correct? We need to think of these 3 parameters, right? Just like we need physical fitness, what the market needs is corporate profits or earnings growth. As long as earnings growth continues to come, market will continue to go up, right? If earnings growth reduces, market will start correcting. Second most important factor is the macro sentiment, investor sentiment, right? As long as sentiment is positive, market will continue to go up. The moment sentiment becomes negative, market will start correcting. And the third, just like we need oxygen, market needs liquidity, that is domestic flows and FII flows. As long as these flows continue, market will continue to go up. The moment flows stop or reverse, market will correct, right? So for the markets to go up from current levels, all these three factors have to be positive. Earnings growth has to come in, sentiment has to be positive, and liquidity has to continue. If any of these factors becomes negative, the market will start correcting, right? So in the next 20 odd minutes, let's discuss each of these parameters and see where we are currently, right? So starting with corporate profits or earnings growth. So what do you think, if you think of companies in India, across India, what is happening with corporate profits and earnings? Do you think they are increasing, they are flattened out, or they are decreasing? Depending on, what you see around you, what you read, what you hear, what do you think is happening? Are corporate profits increasing, decreasing, or flat? Increasing, right? All of us can see that, we feel that around us, companies' profits are increasing. And why is that happening? Because as we all know, India is one of the fastest growing large economies, right? Our real GDP growth is around 7%. For the next 5 years is expected to be in the 7–7.5% range, much higher than any of the developed economies and emerging economies. At the same time, what we are seeing is that as far as corporates are concerned, the return on equity that they are making on their investments, that has also been improving after COVID. This is very important because what happens is that leads to a rise in profit. Now this chart is a very important chart. You can see that from 2003 to 2008, corporate profit to GDP in India was on a rising trend, but from 2008 to 2020, a very long period, it was on a declining trend. And now post-COVID again, it has started rising, right? It's gone above the long-term average. And what we believe is that over the next 3 to 5 years, corporate profit in India will continue to rise, right? Mainly driven by the domestic focus sectors, right? So these are industrial cap goods, banking, real estate, consumer discretionary, and on, right? At the same time, we have seen many of the loss-making sectors have also started making profits, and we believe there is further room for the return on equity to improve, right? So overall, we expect corporate profits to improve, because of which the earnings growth, which is a key driver for stock markets, is expected to do very well, right? So here you can see that before COVID, the earnings growth for the Nifty 50 index was in single digits, 6 to 7% year over year on average. Post-COVID, it has increased. Average is about 17–18%, right? Because of the kind of revenge consumption as we talk about it. But more importantly, for the next 2–3 years also, we are expecting around a 15–16% kind of a CAGR. And like I said, mainly driven by the domestic focus sectors. Now, why has the stock market in India rallied? Because if we compare India with other countries, developed countries or emerging markets, we can see that our earnings growth is much higher than most of the other countries, right? Korea, Taiwan above us because they are very tech focused, but India is number 3, higher than rest of the other countries, right? So overall, earnings growth, the corporate profits in India are doing quite well. Now, that doesn't mean there are no risk, right? Of course, there are some risk concerns we have to keep in mind. Number one is regarding the economy, right? So although I told you that over the next 3 to 5 years, we are expecting our real GDP growth rate to be about 7–7.5%, but if you see in the short term, what is happening, some of the high frequency indicators that we track, that are showing us a little bit of a slowing in the economy, right? For example, PMI indicators, electricity and fuel consumption, the passenger vehicle, two-wheeler sales, right? These are coming up slightly lower than expectations. So the question is our economy slowing in the short term? So that is one concern, one risk to keep in mind. Second is regarding the earnings growth, right? So after the first quarter, we saw that there were some earnings downgrades. Now this second quarter earnings season has started. Some of the companies have not met expectations. Their commentary is a bit defensive. So there have been more upgrades, right? So the question for us is, going forward, will we continue to see some downgrade in the earnings expectations, right? So what I told you, we are expecting around 15% earnings growth. Can that sustain, or will we see some downgrades? That's the other thing to monitor. And the third, of course, is the quality of earnings, right? So if you see the chart on the left, here you will see that the number of companies with a ROE greater than 20% and a CAGR greater than 15% has been declining over the past 20 years, right? So for the stock market to do well, these are two very important metrics. The companies, listed companies, ROE should improve and the profit should also improve, right? So overall, these are the points on as far as earnings growth, corporate profits are concerned that we need to track. But overall, like I said, earnings growth is coming out quite well, so I would say it's a positive. The second factor is the macro sentiment, right? And like I said, across India, wherever I have gone, the sentiment is quite positive, right? And why is that? Now, for that, we need to look at global developments as well as developments in India, right? And as we all know, globally, there are three main regions where everybody is focusing on: US, Middle East, and China, right? In the US, on the positive side, we have seen that the Fed has already started on their rate cut path, right? So they have cut rate by 50 basis points. They're expected to cut another 50 basis points by the end of this year and another 100 basis points next year, right? So when the US Fed cuts rates, other central banks like the RBI in India will also start following them. So we're expecting RBI to start cutting rates from December, Jan, Feb, right? Rate cuts will benefit the US economy. FIIs will also start looking at emerging markets for investment, right? So overall, this is a positive. The concern regarding the US is what? Elections, right? So the presidential elections are scheduled in November. It's a tight race between Kamala Harris and Trump. But if Trump gets elected as president, we all know what that could lead to. There could be some big policy changes, especially on tariffs, and that can lead to higher volatility in markets, right? So that is the one main risk or concern to keep in mind. Second major risk is the geopolitical tensions, right? Especially in the Middle East, the Israel-Iranian conflict, whether that can escalate, right? Now, the main impact for India is in terms of the crude oil price, right? So last week, for example, we had seen crude oil going from $70 a barrel to $80 a barrel because there were fears that Israel could attack Iran's oil facilities or nuclear facilities, right? But just 2 days back, there has been news that US has put pressure on Israel not to escalate the conflict. So Israel has said that they will not attack Iran's oil facilities or nuclear facilities, but they will target Iran's top military leadership, right? So this question still remains whether that can lead to a further escalation. So this is the second major risk to keep in mind. But as far as India is concerned, as long as crude oil price remains between $70 to $80 a barrel, we'll do fine. If it goes up above 90 to say $100 a barrel and higher, then it starts becoming a problem for us because we are a big importer of oil. It starts affecting our current account deficit. The third risk is regarding China, right? The Chinese economy, as you all know, is not doing well. The property sector is in doldrums. So again, last week the Chinese government had announced a big monetary stimulus. They had cut their policy rates, they had cut the home loan rates, right? Announced support for banks, stock market. And because of that, we saw a big rally in the Chinese stock market, right? So at the same time, after that, they have not made any follow-up announcements to support the initial policy measures that they announced, right? So there has been some disappointment and Chinese markets have corrected. It's important to keep the long-term trends in mind, and here if you see what is happening actually, China's ascendancy seems to have stalled and started reversing in terms of its share of the world GDP, right? Whereas on the other hand, India's share of the world GDP has started rising and is expected to go up, right? So this is a positive for us, and that is why one of the reasons why the sentiment in India is so positive. Now coming to India itself, like I said, our economic growth is quite strong. At the same time, most of the other macro parameters we track are also very stable, whether it's inflation, whether it's currency, whether it's interest rates, current account deficit, fiscal deficit, forex reserves, right? All of them are being managed very well. And after a long time, it has happened that our growth is also strong and macro stability is also there, right? And that is the reason why, if we summarize the big picture, the positive factors are much higher than the risks, right? I don't see any big negative trigger as far as domestically in India. Whatever risks are there, they are more global. It's in US, it's in Middle East, it's in China. And because we are a more domestic demand focused economy, we are less impacted by these risks, right? So of course there will be some impact, but the risk will be lower than for some other countries, right? And overall, that's why we are seeing that our markets have rallied to all-time highs. So India's market cap as a share of the total world market cap is consistently increasing, right? That shows us that investor sentiment is positive. Another data point, for example, if you see the BSE 200 index, more than half the constituents are trading at their 52-week highs, right? If we see the MSCI Emerging Market Index here, you can see that the weightage of China has been consistently declining, whereas the weightage of India has been consistently increasing. That shows us that the FI sentiment is still positive towards India and not so positive regarding China. And last, for example, if we see the currency, or one more data point is on the volatility, right? If we see the VIX index, the India VIX index, which gives us an idea of the volatility in Indian stock markets, it is still quite low, right? It had spiked up earlier during COVID, during the 2008 GFC, right? But currently the volatility of the markets is low. The beta of the Indian stock market compared to other countries has been consistently coming down, right? This also tells us that sentiment is positive. And the last data point I want to share with you is regarding our currency. Yeah. So here we can see that after a long time it has happened that our currency has been stable, right? Notwithstanding what's happening in the US, in Middle East, in China, in Russia, Ukraine, RBI has done its job very well and our currency is stable at around 82, 83, 84 rupees to the dollar, right? So all these data points tell us that macro sentiment is positive. The last factor, like I said, is liquidity, where we need to look at both domestic flows and FII flows. Now domestic flows, you know more than me that they are very strong, right? If you look at mutual funds, the monthly SIP number has risen to 24,500 crores, right? Which is doubled over the past 2 years. At the same time, mutual funds also get 15-20,000 crores in net lump sum every month, right? So in total, mutual funds are getting about 40 to 45,000 crores per month, right? SIPs plus net lump sum. In addition, people also invest directly in the stock market. Number of demat accounts have risen, and 15 to 20,000 crores is invested by retail investors, HNIs, directly in the stock market, right? So 45,000 crores in mutual funds plus 20,000 crores direct stock market is of 65,000 crore inflow into our equity markets. That is one of the main drivers of this one-way rally in the Indian equity markets. And this is what is shown here compared to previous countries. If you see calendar year 24, the average monthly inflow into Indian equity markets is $7.5 billion per month. That's the 65,000 crore number I was telling you about, right? So as you can see, in previous years, this was very low, right? And we have seen a spike over the past 2-3 years, and especially this calendar year, right? $7.5 billion or 65,000 crores of domestic money is coming into equity markets every month. In addition to this, the EPFO, NPS, ULIPs together contribute another 15,000 crores a month, right? So in total, about 80,000 crores or $10 billion per month is coming every month into Indian equity markets, right? With that kind of domestic inflow coming in, we have seen that the market has not corrected, right? So this is a very important number to keep in mind. And why is this happening? Because investor awareness has increased, right? So everywhere where I have gone in India, our distribution partners have told me that now they don't need to go and educate investors, right? Investors themselves come and say that they want to invest in mutual funds and start SIPs. This is also another interesting data point. This shows as a share of financial savings. Financial savings means the money we put into bank FDs, keep in cash, put in insurance, pension funds on equity markets, right? So that's called financial savings. Now if you see the previous years, this number, the share of equity as a percent of our financial savings per year was just 6-7%. This increased after COVID, but if you see in 2024, this number is 20%, right? So 20% of household financial savings is going into equity markets, right? With this kind of money coming in, markets have no way but to go up, right? So this is also an important data point to keep in mind. Now the biggest question is, where is this money coming from, right? So what do you think is happening? Where do you think this money is coming from? The money that is coming into equity markets, where is it coming from? Bank FDs, right? So just look at these two charts, right? If you see earlier what was happening, in bank FDs were getting 24% of the annual household financial savings, right? But in 2024, they are getting only about 19%, right? 5% less. That is going into equities. Insurance also, earlier was getting 10% of the financial savings, now it's getting only 7%, right? That is also money moving into equity markets. And overall, equities are getting a higher share of the financial savings, right? So, as I mentioned to you, investor awareness is increasing because of the efforts that all of you are putting in. People like yourselves are putting in across the country, and that is the reason money is flowing out of bank FDs and going into equity markets, right? So, the key question is, can we expect this trend to continue? And for that, we have to look at some long-term trends. So, as you all know, if you look at the average household asset allocation in India, almost 50% is in property. My colleagues tell me that even in Kerala, property is one of the most favorite investments, right? And that is borne out in this chart. Second, again, gold, which you would know in Kerala, it's a favorite investment. Across the country also 15% is in gold. Bank deposits is 13% and equities is only about 6%, right? So the question is, can it increase from here? And for that, we need to look at some long-term trends. So if you look over the past decade, this chart here, in 2013, only 2.2% of household assets were invested in equities, but in fiscal year 24, it had risen to about 6%, right? So let's say it tripled over the past decade, right? The question is, what can we expect over the next 5 to 10 years, right? So equity as a percent of average household asset allocation is, let's say, 6% right now. What can we expect over the next 5 to 10 years? So for that, we need to look at what happened in other countries, right? So for example, in the US, equities is 22% of household asset allocation. In Japan, it's 17.5%. In Eurozone, it's 12%, right? So I think that over the next 5 to 10 years, even in India, this 6% number can easily become 12%. It can double from here, right? So what it means is that the huge inflow that we are seeing into equity markets that is happening, the domestic liquidity that we are seeing, I think that will continue going forward, right? And that is a big positive as far as Indian equity markets are concerned. The second factor we need to look at is, of course, the FII flows. So here also there is an interesting trend. Typically after elections, FII flows tend to pick up because they see which government has come in power, is there policy visibility, right? And that's what we are seeing this year also. In June, July, August, September, FII flows had increased. Over the past month, of course, they have declined, become negative because some of the FIIs have taken the money out of countries like India, Japan, Korea, Taiwan and shifted it to China. But like I mentioned to you, there has been disappointment as far as the Chinese government's policy announcements have been concerned, and we believe that FII flows to India will start coming back, right? So on average, we are seeing about 15 to 20,000 crores per month of FII inflows in India. This year, we are still at positive $5.5 billion of FII inflows, right? So if you think about it, 80,000 crores of domestic inflow per month plus 20,000 crores of FII inflow per month, which is a total of 1 lakh crores, which is coming into our equity markets every month, right? And that is one of the reasons I believe that Indian equity markets will continue to be in an uptrend, right? One last data point, which again you should all know, is the amount of cash that mutual funds are sitting on. Currently, as an industry, AMCs are sitting on about 5.5% of AUM, which translates to 1.6 lakh crores, right? We are sitting on cash of 1.6 lakh crores. At the same time, the balanced advantage funds and other hybrid funds, they had reduced their equity allocation. If market corrects, they can deploy more into equities, increase the equity allocation, right? So they can deploy as much as 60,000 crores. So 1.6 lakh crores plus 60,000 crores, a total of 2.2 lakh crores of firepower is sitting on the sidelines in case the market corrects, continues to correct from here, right? So what that tells us is, with so much liquidity coming in, we can't expect market to see a big correction, right? And that's why we think that what we are seeing now, let's say a 5% correction, 8% correction, 10% correction, that may happen, but with so much money sitting on the sidelines, there will be a recovery and market will continue to go up, right? So overall, what we can say is that, to summarize, all of these parameters are positive, right? So earnings growth is a check mark, macro sentiment is a check mark, liquidity is a double check mark, and because of that, I believe that equity markets will continue to go up gradually from here, right? And that's reflected in the numbers. If you see the Indian equity market returns, you will see all green. This shows over the past 25 years, 1 year return, 2 year return, and so on, up to 25-year CAGR. since 2015, Indian equity markets have not given a negative return, right? And because of that, there are two risks that have come up, right? There are always risks. We are never free from risk, right? So what are the two risks that have happened because our Indian equity markets have seen a continuous rally? What do you think are the risks currently? Yes, very good, right? Number one is the investor expectations. If you see the numbers, because we are seeing over the past 5-year CAGR from Indian equity markets is around 20%, right? But 10-year, 15-year, 20-year CAGR is around 11 to 13%, right? So now if you go or we go and tell clients, please expect a 10 to 12% kind of a return, they will not accept it, right? Earlier they used to be okay. A year back, maybe let's say they expected 18-20%. Now they're expecting how much? 40 to 50%, right? Investor expectations are very high, and this I have seen across India, right? And whenever expectations are high, it can lead to disappointment, right? That is the first major risk, right? High expectations are followed by bigger disappointments, right? Which is what we want to avoid. So from our side, we continue to tell investors that, you know, the 5-year, 10-year, 15-year, 20-year CAGR is around 11 to 13%. So that is a number which we should anchor to, not 20% or 40%, right? The second risk is in terms of valuations. Now, this is a chart showing the trend of profits and market cap of the top 1,000 companies in India. As you can see, in the long term, they go in line, right? But since COVID, there has been a big divergence, right? So red line is the profits, green line is the market cap of the top 1,000 companies in India. And clearly, we are seeing that the market cap is running way ahead of the profits, right? But we did an analysis, drill deeper down, and typically what we have seen, it takes 5 to 6 years for the profits to double and about 4 to 5 years for the market cap to double, right? What has happened over the past 3 years is an anomaly. After COVID, you know, profits have doubled in 3 years. Normally it takes 6 years, right? And that has led to the rally in the markets and the high investor expectations. This is also seen if we see the dichotomy across large cap, mid cap, small cap, micro cap. We looked at, okay, the share of profit, share of market cap, share of capex, share of gross block, share, you know, how the ROEs are trending. And you can see clearly that in all of these parameters, you know, the large caps stand out, right? They are doing quite well. As we go down to mid cap, small cap, micro cap, we can see that their profit growth is not that high, ROEs are not that high, right? So it means that the risk is building up, right? So overall, that's what's happening. As far as large caps are concerned, we don't think valuations are that big of a concern, but risk is there in mid cap, small cap, micro cap, right? So large caps are still trading at a reasonable premium to the long-term average valuation, but mid caps, for example, are trading at 50% premium, small caps at 80%, micro caps at 100% plus premium, right? So I'm not saying that we are expecting a big correction in markets, right? But if there is any negative event and if markets correct, then the risk is larger in mid cap, small caps, right? So that is something we have to keep in mind. So overall, in terms of asset allocation, what are we suggesting? Equity markets, like I said, because earnings growth is positive, sentiment is positive, liquidity is positive, we can continue to expect markets to gradually go up from these levels. We don't anticipate a major correction. More importantly, where are the opportunities to invest? So there we do this analysis where we look at profit pool share, market cap share, ownership share, and so on. And this is our framework when we do the sectoral allocation, right? So what we believe currently is, for example, these sectors, IT, pharma, auto, cap goods, realty, these could continue to remain in momentum for some time, right? Some of the dark horse sectors, especially, for example, consumer durables, metal, cement, which have not been doing well, we think discretionary consumption, so consumer durables, home appliances, these stocks can also start doing well. And lastly, some sectors where we think are overvalued, especially the defense, PSUs, railways, utilities, we think there is a high amount of risk there, better to avoid those, right? And look at some of these other sectors. Lastly, in terms of factors, we look at growth, value, quality, and there we have seen a clear shift, right? Till about May, June, value was still doing well. Value means all your, PSU companies that were there, defense, railways, utilities, those were value, right? But after the big rally, they have become overvalued, right? And now that we are in an environment where rates are being cut, we expect growth and quality to do better, right? And that's what this chart shows, that quality and growth has started to do better than value. So to summarize, large caps still, less risky than mid cap, small caps, although there is money still coming in mid and small caps. In terms of sectors, IT, pharma, discretionary consumption, right? Private banks, NBFCs, domestic manufacturing, these are some of the segments to look at. Fixed income with interest rates cut is expected. We expect fixed income to do well, especially at the longer duration, right? So it's important to move to gilt funds, dynamic bond funds, corporate bond funds, and so on. And lastly, commodities like gold. So we all know gold has risen to all-time high, mainly because of three factors: rate cuts in the US, rising geopolitical risks, and central bank purchases of gold, right? So because of that, as these factors remain in play, we can expect gold prices to remain strong, could potentially go higher from here. So important to have gold also in the investor's portfolio. So now, with that backdrop, what are some of the funds we are recommending? The top recommendations are the asset allocation products, especially our asset allocator fund of fund and the multi-asset allocation fund, because you get immediate diversification across different asset classes. Then on the equity side, the diversified funds like flexi cap, multi-cap fund, or maybe the large cap frontline equity fund. In terms of sectoral thematic, like I mentioned, our Digital India fund, which invests in IT, tech companies, Gen Next fund, which invests in discretionary consumption, right? Our pharma healthcare fund, manufacturing equity fund are some funds you can look at. And lastly, the quant fund, right, which is run a bit differently from the others. So I'm just going to tell you briefly about how we manage some of these funds. So first is the asset allocator fund of fund, which I manage. Here we have a lot of flexibility in terms of allocation to different asset classes like equity, fixed income, and commodities. Equity can range between 20 to 80%, fixed income 15 to 75%, and commodities between 5 to 15%. There is a process we follow. Step one of that process is we get inputs from a quantitative model which looks at different metrics across valuation, across volatility and momentum. And currently our model is recommending 62% allocation to equity, which is slightly higher than what you can see in some of the competition funds, right? Step two, then I use this earning sentiment liquidity framework that I walked you through. Because all three factors are positive, I am maintaining a slightly higher equity allocation between 65 to 70%, right? And last, in terms of the sector rotation, which is important to generate alpha, what I talked you through in terms of the framework we follow, where we think that, for example, IT, pharma, domestic manufacturing, banking, financial services are some sectors we can look at, right? So overall, if you see the performance of our fund, because of the past year, we have had a positive view on equities. I have maintained a slightly higher allocation between 60 to 70%. Also, I've had a good healthy allocation to gold between 10 to 15%. So the 1 year return of the Birla Asset Allocator Fund of Fund is around 32%. The peer set average is about 22%, right? So there's a 10% outperformance as far as returns are concerned. But more importantly, we have to look at risk also. So the volatility of the standard deviation or the beta of our asset allocator fund of fund is just half that of the Nifty index, right? So the risk is lower and the return is also very good. So the risk return profile is very good. The 3-year CAGR is about 16%, 5-year CAGR is about 18%, right? So our target is to deliver a 3-year CAGR of 15% with low volatility, right? And that's what we are gearing the portfolio towards. This is the current portfolio. I won't spend too much time on it. But the asset allocator fund of fund is like a mirror to Birla, right? It's like the best of Birla essentially. Here you will find the funds that we want you to recommend to your investors, right? Flexi cap fund, multi cap fund, Gen Next fund, Digital India fund, pharma fund, banking fund, and so on. So you can just look at the asset allocator fund of fund portfolio and you will know what our recommendations are for investors. Lastly, like I was mentioned, because asset allocation is my pet topic, I had written a book on this subject which was published by Penguin India last year, where I have tried to bring out the analogy between investing and running a marathon. Definitely you can look at it, it's available on Amazon, and if you think it's relevant for your investors, you can suggest it, right? The second fund is a multi-asset allocation fund. This gives exposure to 4 asset classes: equity, fixed income, commodities, and REITs in WITs, right? So it's a very well diversified fund, 60 to 65% allocation to equity, 10 to 15% to fixed income, about 10 to 15% to gold and silver, and 5 to 10% to REITs InvITs, right? And some of the themes we are playing in this fund is banks and NBFCs, discretionary consumption, industrial capital goods, and IT and tech, which are the growth and quality oriented sectors that we are positive on currently. The third fund is the FlexiCap fund, right? So here the philosophy we follow for the FlexiCap fund is what we call the best of breed investing. What it means is that our FlexiCap fund invests in stocks that satisfy these criteria, right? So the stock has to be a sector leader. It has to be a top 3 in the market cap. It has to have grown revenue which is at a faster rate than other companies in the sector. The margins have to be higher than competition, and lastly, return on equity, return on capital employed have to be higher than companies in the sector, right? So what are some of the stocks that we have invested in? So almost 75 to 80% of the AUM of FlexiCap fund is invested in best of breed stocks, and these are some examples like Chola Finance, Bharat Forge, Apollo Hospitals, right? Exide, Bharat Electronics. And out of the, for example, 60 stocks in the portfolio, like I mentioned, 80 stocks, almost 48 to 50 stocks are these kind of best of breed. And that is the reason why, if you see the long-term performance of a FlexiCap fund over the past 25 years, it has given a CAGR of almost 20 to 23%, right? And if you look at any 5-year, 10-year period, almost 100% of the time it has given positive returns. So this is one fund which is right now in the first quartile across time frames, which you can definitely recommend to investors. The fourth fund is a frontline equity fund, which is a large cap fund, right, which has been around for almost 25 years, again given a CAGR return of almost 20 to 23%. And the reason is the disciplined manner in which this fund is managed, right? So we only invest in the highest quality companies with a dominant business, with a wide moat, clean balance sheet, no corporate governance issues, and improving trends of revenues and margins, right? And because of that, if you see the portfolio, you will see all the top names here which have given, which are called long-term compounders essentially, right? And we expect that from a stability point of view, this is a very good addition to the investors portfolio. If you see the past 20-25 years, almost 75% of the time, the frontline equity fund has been in the first or second quartile, and we expect that to continue going forward. Last fund is the quant fund, which we had done an NFO in June. So here the process is slightly different because there is no human fund manager input. It's completely run by a quant model where we start with the common stocks which are in the top 75 holdings of the top 20 AMCs. We only look at large and mid cap to reduce the risk, right? Then we apply a quality factor filter. We apply the momentum factor filter. We look at volatility, and we construct a portfolio of about 40 to 50 stocks, right? The key thing here is that, like I said, this is run on autopilot, right? So normally when we board a flight, the human pilot only flies the flight only for 1 or 2 minutes, right? Rest of the time it's on autopilot. The same thing with the quant fund. It will be run on autopilot using the quant model unless there is some disruption in the market or in a particular stock, right? And that is reflected in the portfolio of the quant fund, of the Birla Quant Fund. If you see names like HDFC Bank, Reliance, ICICI Bank, Infosys, TCS, you will not find this in our portfolio. What are the stocks you will find? This is the list of stocks you will find, right? BPCL, Colgate Palmolive, and so on. Because these are good quality stocks, they are in momentum, and the volatility is low. So we expect the quant fund to do quite well. It will behave differently from the other stocks in the investors portfolio, other funds, and it's a good addition from a diversification point of view. So let me stop here. If you have any questions on the market outlook, if you have some observations or on any of our funds, I can answer them.
Ladies and gentlemen, any questions? Yeah.
Hello, sir.
Yes.
If you see the emerging market index, India's weight has been continuously increasing and China's weight has been continuously coming down.
Right.
Now the weight is almost equal. Given the size of the Chinese economy is 5 times bigger than Indian economy, the weight should be proportional to the market cap.
So see, the weightage in the index depends on how the underlying stocks perform. Okay, it doesn't depend on the size of the economy or how fast the economy is growing, right? So what had happened was, the Chinese economy was not doing well, and I had shown the chart here, right? So because the Chinese economy was not doing well, their stocks were not doing well. So there was no investor interest. FIIs had started taking money out of China and putting it in countries like India, Korea, Taiwan and so on, right? And because of that reason, that the stocks, underlying stocks were not doing well, right? Sentiment was negative, money was flowing out. The weightage of China in the emerging markets index continuously declined, whereas the weightage of India kept on increasing, right? Which is what I had shown here in this chart, as you correctly pointed out. Weightage of China has halved from about 45% to 22%. Weightage of India has tripled from about 6-7% to 20-odd%, right? So it's completely a function of the market movement. It's not a function of the underlying size of the economy or the growth.
So market movement in turn is a function of the GDP now, sir.
So it's again, it's not only a function of GDP, right? So that is the reason I was showing you this framework. You have to look at these three things, right? The GDP only affects the earnings growth. Like India's economy is doing well, real GDP is increasing, so companies are doing well, earnings are increasing, right? But if sentiment is negative, market will not go up. If there is no liquidity, if domestic investors are not investing, foreign money is not coming in, market will not go up. And that is the reason, I mean, it's a very good question you asked, because again I want to reiterate the reason I walked you through this framework is that you need to keep track of all these three metrics. You can't just look at one metric, right?
Sir, given the earnings growth now, Chinese earnings growth at 12%, but Indian earnings growth is 17%. That means their earnings growth is 80% of the Indian earnings growth. If you see the valuations are more than 50% discount to the Indian market. So when the mean reversion comes, I think China will perform better than the Indian market would.
See, the question is, it might be true on a historical basis, but the equity markets are forward looking. They always discount the future, right? And that is the big question. What can we expect from China and what can we expect from India? Where is the visibility higher, right? Now imagine you are a FII investor sitting in New York or Dubai, Singapore, Hong Kong, right? You are seeing, okay, I am comparing China, India, Korea, Taiwan, Japan. I have a lot of options, right? Where do I have better visibility to economic growth and earnings growth, right? Where is sentiment positive? Where is liquidity coming in, right? China, like I told you, the economy is not doing well. There were a lot of expectations that the government would announce a big stimulus. The expectation was for a 6 trillion RMB stimulus. Government has only announced a 2 trillion RMB stimulus. So there is a big disappointment, and we have seen the Chinese stocks correcting after that, right? Then the question is on the property sector. It is still in the doldrums, and I should tell you that in India, only 50% of household assets are invested in property. In China, that number is 80%, right? If I have invested in property, it's in loss, I will be not confident about spending. That's what's happening. Chinese consumers are not touching their savings. They are not spending. And that's the reason Chinese economy is not expected to do well. Their stocks are not expected to do well.
Right, thank you.
Thanks a lot. Thank you. One last question. We have time for one last question. Please.
Sir, you make a comparison between household investment into equities, okay,
Yeah.
between India and US. India,
Yeah.
I think it's less than 5%, and in US it is approximately 20%.
Yeah.
So if you make a comparison like this,
Yeah.
is it a desirable trend if it keeps on increasing? See, one is in US, the market capitalization to GDP, I
Yeah.
think it's more than 200%, and in India it's almost 150% or something, right? And if it keeps on increasing like this, see, you have a lot of default money coming in through the SIPs and all those actually on autopilot. In case the sentiment reverses, if something happens, the whole thing can come to a what you call standstill or reverse actually. So is this trend going to continue, or is it really lead to a kind of bubble in the market?
Sure, sure. So definitely, see, that's a risk that is building up, and that's why I'm not saying that this will be a linear trend of money moving into equity markets, right? Like we have seen in previous years, it goes up, can come down and go up. Definitely, the markets always move in cycles, right? But as long as the underlying economic growth is there, India is a growing country. Next 15, 20, 25 years, it will go on the same trajectory that the US had gone, China had gone, right? So underlying economic growth, if it sustains, earnings growth, if it sustains, right? If sentiment is positive, then this money will keep coming in. But it will not be linear. I completely agree with you. There will be periods of time where it will correct, there will be a cycle, and again it will go up from there, right? So as investors, we have to be prepared for that, but we have to keep a, let's say, 5 to 10 year horizon. More money will come in. just like what happened in US, Euro, other countries, and market will continue to go up. That is my key message.
Thank you, Vinod.
Thank you.
Wonderful presentation. Please give him a big round of applause.
Thank you.
So, couple of things from his presentation. We are in the right business. He reinforced that with lot of points. Especially, he was mentioning about the amount of money coming into equity significantly has changed. The amount of savings going into the bank deposits have come down. So, it's a good time to be in this business. The business is growing. The three factors he told about mental strength, physical strength, and oxygen. Am I right? Yeah.
Yes.
All things are in favor. And many of us have this question of, is this the right time to invest? If it corrects, what will happen? He also gave an answer for that. There are quite a bit of diversified funds which are keeping around 5% in cash, plus hybrid funds, put together 2,20,000 rupees in cash. Any corrections, will be buying. So, people who have concerns on that, he also addressed that. But he also mentioned that there's a significant overvaluation in micro cap followed by small and mid. So, large cap is relatively not that stretched. So, and doing an asset allocation will do good, and even gold has done well. If certain things persist, it will continue to do well. So, keep all the assets in your portfolio, do a good asset allocation. Thanks a lot. Wonderful presentation. Ladies and gentlemen, one more round of applause for him.
Thank you, Vinod. But sir, can we have Mr. Shashi Kumar to kindly come forward? In the meantime, we would like to call upon on stage the Aditya Birla Sun Life Mutual Fund team from Kerala, Mr. Sajesh, Regional Head Kerala. Mr. Sajesh, are you here? Yeah. Ms. Arya Ashok, Branch Manager, Aditya Birla Sun Life Mutual Fund, Cochin. Mr. John Abraham, Branch Manager from Trivandrum. Mr. Kiran, Branch Manager, ABSLMF, Thrissur. And Mr. Srihari, Branch Manager, Kottayam. Shashi Kumar, please hand over our token of love and appreciation to Mr. Vinod Bhat. And you see the entire ABSL team of Kerala standing before you. Please give them a big round of applause.